Iraqi Dinar Today latest news, and we begin our broadcast with developments that have caused an absolute shockwave across the global financial community. Today's report centers on a paradigm shift in the valuation of two previously obscure currencies, the Vietnamese Dong and the Iraqi Dinar. The magnitude of this reported movement is unprecedented, breaking decades of historical price stagnation and challenging the fundamental perception of these assets. For those who have followed the nuanced world of emerging market currencies, this is the sudden, intense moment of revaluation that was often hypothesized but rarely expected to materialize with such force. The core of this explosive financial news revolves around astonishing figures now being circulated within trading circles and community reports. The Vietnamese Dong VND is reportedly demonstrating a valuation reaching $4.09, while the Iraqi Dinar IQD is showing an even more elevated rate of $4.18. These numbers are transformative because they shatter the long-standing status quo, where both currencies consistently traded at minute fractions of a single U.S. penny. Such a dramatic thousands of percent shift takes the discussion out of the realm of theoretical possibility and places it squarely in the context of immediate, real-world economic implication. For years, both the Iraqi Dinar and the Vietnamese Dong were effectively invisible to the major institutional finance players across the globe. The Dong served a crucial but localized role in Vietnam's growing economy, primarily facilitating internal commerce, regional trade, and the burgeoning tourism sector within Southeast Asia. It was not considered a significant instrument for international wealth storage or large-scale capital management. Its value remained closely controlled, a tool of monetary policy, not a freely traded global commodity. A similar narrative of obscurity surrounded the Iraqi Dinar. It remained largely confined to Iraq's internal commerce and essential remittance channels for Middle Eastern communities. Global investors frequently overlooked the IQD, often dismissing it as too susceptible to geopolitical instability, oil price volatility, and general market risk stemming from its tumultuous history. These factors relegated both the dinar and the dong to the status of niche, contrarian assets, unwatched by the mainstream, yet perhaps quietly positioning themselves for a future re-entry onto the global stage. The reported valuation of $4.09 for the Vietnamese Dong signifies a monumental leap beyond its historically managed price range. Central banks typically manage a currency's value to maintain export competitiveness, making such vertical surges extraordinarily difficult to achieve. This new reported trade value suggests the market's perceived worth of the dong has undergone a complete recalibration. It implies that the currency has transitioned from a stable but low-yield tool for local transactions into a highly desirable, globally traded asset, signaling an aggressive newfound confidence in Vietnam's economic infrastructure. This powerful upswing in the dong's value is being interpreted by market observers as a strong vote of confidence in Vietnam's manufacturing power, its export capabilities, and the nation's overall long-term stability. The market appears to be pricing in a sustained period of economic growth and global integration, fundamentally altering the perception of Vietnam as a major global supply chain participant. Such a price action forces a necessary reevaluation of not just the Vietnamese economy, but also of the dynamics of other high-growth Southeast Asian emerging markets. Turning our attention to the Iraqi dinar, the reported rate of $4.18 is perhaps even more striking, considering its recent and tumultuous past. Historically, the IQD has been associated with geopolitical instability and war, factors that kept its value chronically depressed and largely outside of global banking systems. Long-standing financial dogma positioned the dinar primarily as a high-risk speculative currency, with traditional financial advisors often cautioning against its inclusion in a serious international portfolio. The reported valuation surpassing the $4 mark actively dismantles those long-held assumptions in real time. If the dinar is indeed trading at this elevated price point, it strongly suggests that the underlying issues which historically suppressed its value, such as internal security concerns or a lack of international banking system integration, have either been successfully addressed or superseded by compelling new financial realities. The IQD narrative may be transitioning from a cautionary tale of economic risk to one of the most unexpected turnaround stories in modern global currency history, reflecting a newfound perception of stability and economic governance in Iraq. A critical question remains: what macroeconomic factors could simultaneously drive such a dramatic, coordinated leap for two previously secondary currencies? The answer likely lies in a complex interplay of shifting global capital flows and a renewed confidence in the underlying economies. As major world economies grapple with fluctuating inflation and unstable interest rates, international investors are aggressively seeking opportunities outside of traditional Western assets, with emerging markets offering genuine revaluation potential becoming highly attractive destinations. This capital, both Vietnam and Iraq, appear to be primary beneficiaries of this global hunt for diversification and new growth opportunities. Vietnam's booming manufacturing sector and its emerging role as a key alternative in the global supply chain provide a solid economic foundation. For Iraq, the appreciation suggests market perception of improved political stability, more effective management of its vast oil revenues, and potentially greater success in integrating its financial system with the global electronic banking infrastructure. This convergence creates the ideal environment for substantial value appreciation. For the segment of the community that has maintained holdings in these currencies over the long term, this dramatic scenario is a financial and psychological event of immense proportions. An individual who acquired dinar or dong when the value was merely a fraction of a penny, potentially facing ridicule for investing in a seemingly dormant asset, is now witnessing a payoff of unimaginable scale. This validation underscores the strategy of patiently holding contrarian assets when the general market sentiment moves in the opposite direction, proving that entrenched financial perceptions can, and sometimes do, change. The ripple effect extends significantly to diaspora communities and families reliant on international remittances. For years, transferring money or holding savings in the local currencies of Vietnam or Iraq meant dealing with constant loss of purchasing power through depreciation. A revaluation of this magnitude fundamentally alters that dynamic, transforming accumulated savings into a substantial financial windfall. It grants these families greater economic power, enabling them to potentially clear debts, fund educational pursuits, or invest in assets, thus altering the socioeconomic trajectory for countless individuals. However, alongside the understandable euphoria of such a significant price surge, prudent market observers must acknowledge the immense pressure and potential hazards that accompany massive vertical movements. The key principle of market history is that rapid ascents are frequently followed by equally aggressive volatility. A high valuation is not the conclusion of the story. It is simply a new chapter requiring a different strategic mindset. Market sentiment is notoriously fickle, and regulatory changes or unexpected political events can rapidly reverse paper gains. One of the most essential considerations in a hyper-volatile scenario is market liquidity. While a screen may display a theoretical value of $4.18 for the dinar, the practical ability to find a buyer willing to execute a transaction for a large volume at that exact price is a separate and often challenging matter. If liquidity suddenly vanishes, converting the paper value into spendable, hard currency can become exceptionally difficult, regardless of the displayed exchange rate. A phenomenal rate is meaningless without a functioning market mechanism to facilitate the exchange. Furthermore, a critical analysis must determine if the current surge is fundamentally driven by sustained, underlying economic strength or primarily by intense speculation and momentum trading. Sustainable, long-term currency value is typically built on years of robust trade surpluses, disciplined fiscal governance, and consistent foreign direct investment. If the current price action is largely disconnected from these foundational realities, the subsequent correction could be both severe and swift. Investors must remain highly vigilant against succumbing to the fear of missing out, which often blinds decision-making. The macroeconomic consequences of these currencies suddenly becoming major global assets are profound and far-reaching. A rapidly strengthening currency can negatively impact a nation's crucial export competitiveness. For instance, a stronger dong makes Vietnamese manufactured goods more expensive for international buyers. Similarly, a stronger dinar alters the entire dynamic of Iraq's vital oil trade. These shifts influence global trade balances and investment flows, forcing central banks in neighboring countries to reevaluate their own monetary policies to remain competitively aligned. Therefore, for those contemplating engaging with these currencies at this advanced stage, the correct approach requires deep, calculated introspection. If one's belief is anchored in the long-term industrialization of Vietnam or the successful reconstruction of Iraq, the strategy may be one of patient accumulation. Conversely, chasing a rapid return based purely on a sudden price spike is historically a perilous endeavor. The most measured strategy involves a balanced view, weighing the potential for marginal further gains against the very real and present possibility of a sharp correction. The single most effective tool for navigating this extremely complex landscape is accurate, real-time information. Market participants must remain glued to official central bank communications from both Iraq and Vietnam, monitoring news regarding new economic reforms, significant international trade agreements, and consistent export growth data. Furthermore, tracking global commodity prices, particularly crude oil, is vital, as this resource dictates much of Iraq's economic health. Being both early and exceptionally informed is the only viable path to turning market risk into a calculated, strategic opportunity. Ultimately, the story of the Vietnamese Dong at $4.09 and the Iraqi Dinar at $4.18 is far more than a simple numerical event. It serves as a potent signal of a potential, albeit volatile, shift in the hierarchy of global finance, challenging entrenched assumptions and presenting opportunities juxtaposed with significant hazards for those who are unprepared. Whether this moment represents a life-changing financial event or a harsh lesson in market dynamics will hinge entirely on the ability of holders and observers to remain disciplined, cautious, and strategically engaged with the factual mechanics of the market, not just the fleeting excitement of the valuation